Hey guys, what's up? Welcome back. My name's Tom. I'm head of the Recessionist, a channel built around an economic predictive model that's been crushing it since launch. Since we went live end of November, we've been calling major moves before they happen. Bitcoin's collapse from 94,000 down to 65 called it at the peak. The BLS jobs overcount scandal, 800,000 fake jobs that we predicted months before the official revision. Our safe portfolio strategy beating the S&P by 3 full percentage points while everyone else bought the AI hype. Defensive stock picks gaining 7 to 18% while tech stocks got demolished. So when I tell you that most people, including the so-called experts, are looking at recession signals completely wrong, and I can show you how to see what's coming months ahead of the crowd. I've got the receipts to prove every single word. Right now, the financial media is completely obsessed with daily noise. Every Fed meeting minute, every weekly jobless claims report, oh no, up 10,000 this week. Every single stock market wiggle gets breathless coverage. But here's what they're fundamentally missing. Recessions don't announce themselves in headlines with flashing red sirens. They build slowly, methodically in the underlying economic data. The warning signs show up months before anyone in mainstream finance notices, and most people, even smart investors, are watching the wrong indicators entirely. They're hyper-focused on lagging indicators that tell you what already happened, when they should be laser-focused on leading indicators that tell you what's happening next. They're driving by looking in the rearview mirror instead of through the windshield. It's like trying to avoid a car crash by studying the accident report instead of watching the road. The whole approach is backwards. Our recession risk score today sits at 64 out of 100. That's up 2 full points just this week. We're firmly in pre-recession territory. Not in recession yet, but the economic dominoes are definitely falling in sequence. 10 out of 18 core indicators are flashing bright red warning signs. Let me walk you through exactly what most people completely miss when they try to predict recessions. First major mistake, everyone obsesses over the unemployment rate, 4.3% right now. Politicians love to tout this number, look how low unemployment is, but that's completely backwards looking. Unemployment is the ultimate lagging indicator. By the time the unemployment rate spikes, you're not predicting recession, you're already deep in one. The real signal that smart money watches, continuing claims. That's people who stay on unemployment benefits week after week after week. Right now we're at 1.83 million Americans on continuing claims. That's your real canary in the coal mine. When people can't find new jobs quickly, that's when you know the labor market is actually softening beneath the surface. Second massive blind spot, the yield curve. Everyone celebrated when it finally uninverted a few months ago. Financial media threw a party, crisis averted, they screamed. We're at positive 63 basis points now between 2 and 10-year treasuries. But here's what they don't understand. Tight spreads immediately after a long inversion period, that's actually more dangerous, not less. It signals that credit markets are still fundamentally stressed. If we were truly in a healthy recovery, that spread should be widening substantially as confidence returns. Instead, we're seeing this narrow band that screams continued stress. Third, the jobs data that everyone misinterprets. February showed 130,000 new jobs created. Every headline called it solid or decent. But look deeper, the 3-month rolling average is only 73,000 jobs per month. That's stall speed for an economy that needs at least 150,000 monthly just to keep up with population growth. And here's the massive kicker that our model uniquely accounts for. We add an 18-point penalty multiplier to all jobs data because of what we call the BLS credibility crisis. They've been systematically, consistently overstating employment numbers by hundreds of thousands of jobs. Our model called that massive overcount back in December. The official revision confirming 800,000 fake jobs didn't come until February. We were ahead of that curve by 2 full months. Fourth critical factor, what we call divergence penalty scoring, ADP private payrolls, sitting at 78 risk level. Credit spreads at only 30 risk level. That 48-point gap between private sector reality and Wall Street pricing represents massive market complacency. Wall Street is pricing absolute perfection while Main Street businesses are struggling with real hiring challenges. Meanwhile, the financial cheerleaders are out in full force right now. Soft landing achieved, AI boom continues forever. Don't freak out about jobs data. CNN literally ran that exact headline this week, don't freak out. CNBC keeps bringing on bank analysts saying everything's fine. Goldman Sachs just raised their S&P targets again. But here's the brutal truth they won't tell you. Every single major recession in modern history looked absolutely fine until suddenly it didn't. 2007 looked fantastic until Bear Stearns collapsed overnight. 2001 looked rock solid until the dot-com bubble burst without warning. The 1991 recession blindsided everyone who was focused on 80s prosperity. The pattern's always identical. Labor market softens gradually first, credit conditions tighten slowly second, then markets crash violently third. We're clearly in stage 1 right now with early signs of stage 2 emerging. So what does this actually mean for your money and your financial future? Our model tracks 29 distinct economic indicators because no single metric ever tells the complete story. It's all about recognizing patterns and structural shifts, not reacting to daily headline noise. Look at consumer sentiment right now, 56.4. The lowest reading in months. That's not random statistical noise. Regular people feel the economy weakening in their daily lives before it shows up in government data. They're cutting spending, delaying major purchases, feeling uncertain about job security. The VIX volatility index at 21 elevated above normal but not full panic mode yet. That suggests growing unease but not widespread fear. Oil sitting at $71 per barrel, building in a substantial geopolitical risk premium that could spike higher. Bitcoin at 69,000, still down a brutal 35% from the peak we called at 94,000. If you want to track all these interconnected signals in real time, recessionistpro.com has our complete dashboard with all 29 indicators updating live, plus our 18-month forward market forecast for just $20 a month. The model's current 18-month outlook shows a baseline recession scenario as the most probable path, not a sudden dramatic crash, but a grinding, persistent economic slowdown that catches most people completely off guard. Look, I completely understand the psychology here. Nobody wants to hear recession talk when their 401k just hit fresh all-time highs last month. I get that this isn't fun content, but protecting and growing wealth over the long term means learning to see around economic corners before the crowd does. Bottom line, I remain heavily defensively positioned right now. Cash, heavy portfolio. Dividend-paying stocks over speculative growth plays. Essential commodities over high-flying tech. Real estate investment trusts over meme stocks. The 64 risk score isn't full panic territory yet, but it's definitely serious caution territory. This isn't about timing the market perfectly. Nobody can do that consistently. It's about not getting caught completely flat-footed when the economic tide inevitably turns against risk assets. Here's my specific, measurable call for the next 60 days. If continuing unemployment claims hit 2 million people in the next 2 months, that's my official recession confirmation signal. We're at 1.83 million right now. Watch that number like a hawk every single Thursday when it gets released. It'll be the canary that stops singing right before everything else falls apart.